Hi, welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and founder of Moore Squared Communications. Each episode, I welcome a guest to the show to share his news story of the week. And this week, I'm delighted to welcome Joe McDonnell, Chief Investment Officer of Border-to-Coast Pensions Partnership. Welcome to the show, Joe.
Delighted to be here, Charlotte. Thank you for having me.
Well, delighted to have you on the show. Do tell us, what is your news story of the week?
Well, my news story of the week is a new blueprint that's being developed by IFM investors in conjunction with major asset owners in Australia and the UK, entitled Mobilising Pension Capital for Net Zero. So essentially calling on the government to make certain changes from a regulatory perspective to improve the environment for investing in infrastructure in this country.
And that includes this report that you talk about spurred the FT to write a story with the title "Pensions Funds Call for UK Fiscal Rule Change to Spur Investment," and that came out on the 8th of October last week.
That's right. So there's been so just on that, there's been a range of different recommendations from us, but absolutely one of the key recommendations is that change in fiscal rules to reflect the fact that infrastructure investment is an asset and shouldn't be viewed just simply as debt.
Okay, and that's of interest to professional investors because?
Well, ultimately, I think it would support the government to provide more capital through its new vehicles, so GB Energy or the new National Wealth Fund, which will provide some stage one investment into infrastructure and therefore encourage other private institutions to invest more heavily in infrastructure as well. So giving the government a bit more flexibility, if you like, to start that investment process.
And this news story is of interest to me as well, because this is the first time on this show, and this is only the 4th episode, that the person on the show is actually included in the news story. And actually somebody from 2 episodes, Greg McClymont, is quoted in the news story. So I'm feeling like I'm very much on the zeitgeist right now.
Well, yes. I think, what I particularly like about this story, it is, as I said, it's bringing together asset owners with IFM, who is a well-known, Australian and UK infrastructure manager. I think in all about £1.7 trillion of asset owners have got together to really co-author this piece of work. It's in direct response to the government's targets. The government has a clear target to say we want clean energy by 2030. Today, 40% of our electricity is developed by renewables, which is great in itself, is pretty good on a relative basis to many countries. And indeed, I think we're second only in terms of offshore wind to China. So we've done an awful lot. But that said, only in the last, if I look over the last 3 or 4 years, only about 9 gigawatts of power have come on, renewable power have come on. And really, if the government wants to hit its clean energy target by 2030, it needs to actually see 140 gigawatts of new alternative energy come on, which is a huge leap from where we are today, and giving themselves only 6 years. So, they're articulating, saying, look, we need to double the size of offshore wind. We need to triple the size of solar. We need to, quadruple the size of offshore wind to get anywhere near those sorts of targets. So it makes perfect sense, I think, for asset owners to get together and say, look, we understand these targets, but if you are serious, you need to make some fairly significant policy initiatives in order to be able to make that happen.
And you said to me that this is one of the things you really liked about this report, that it's not just going, there's a problem, it's saying, here's the solution.
Well, that's essentially it. I mean, it's the report, which is, I always like short reports, and this was only about 20 pages long, but essentially it's saying, look, you can get the right policies in place to unlock further investment. You can drive further growth, and certainly for myself as a CIO and as an asset allocator, you want to make sure that what you're investing in delivers the kind of appropriate risk-adjusted returns that you need. And the reality is that historically, investors have been somewhat reluctant to invest in UK infrastructure. They haven't had a great experience. So really, the only way to get comfortable, and a lot of the LGPS schemes will be doing their asset allocations and valuations next year. If for them to get comfortable, they have to feel as something has changed, whereby I can expect a bit more return and I'm getting somewhat de-risked if I invest in UK infrastructure. So this report pretty much outlines, 15 to 20 recommendations, that all of which combined would substantially change that risk adjusted return that you're looking for. Because it's essentially, infrastructure is a very curious asset class. It's probably the asset class where government can actually influence the most. Equities go up or down, bonds go up or down, and obviously government fiscal and monetary policy can have some say in all of that. But structural initiatives that government can embark on, through investment or through initiatives, thinking about, driving growth. So like things like contracts for differences, low carbon contracts, repowering, hybrid, all of these things can effectively mean that investors can feel more comfortable that they'll get a good return over the next 10, 15, 20 years plus. And that's what government can do here. They can really drive the investor appetite for infrastructure, like they can't do that for other asset classes, but they can certainly do it for infrastructure.
And you say there are 15 to 20 recommendations. I don't want to go through all 15 to 20 because we might be here for a bit longer than half an hour. But are there maybe 3 or 5 that you think are really important and would make a big difference?
Yeah, I mean, I look, the long-term strategic approach. So thinking about the strategy around GB Energy and the National Wealth Fund, making sure that their investments are put in place to essentially de-risk investments. So, establish, if you like, from concept through to development, different energy opportunities, and then hand that off, if you like, to the institutional investors who'd be happy to take, construction and commercial all the way through to commercial operation. So unblocking that, and I think that, that essential emphasis, I think, around certainly the National Wealth Fund is doing that, and of course also backing new technologies around clean energy. That's a massive positive thing. As I mentioned, although there is a significant amount of money being put into those, the entity like the National Wealth Fund, that could continue to be the case, I think, if they did change those fiscal rules. As I mentioned, there are certain things that can accelerate growth. So where you give the investor, if you like, more confidence that the payoff, if you like, from investing in infrastructure is more stable. So things like extending contracts for differences, thinking about longer duration energy contracts, if you like, improving regulation. So the regulator understands I'm not going to move the goalposts. If I think your required rate of return should be lower, no, it's you're taking risk at the beginning. You should be rewarded all the way through the construction and then the operating when an infrastructure is then operating. And then I think the last point I'd make, which I think is hugely important, is planning. Planning is, again, this is within the remit, if you like, of government as well. If you can influence planning whereby things can happen more quickly, so even have emission and reduction targets on a national planning policy level, also drilling down into a regional local basis. So local authorities feel that every time they look at planning opportunities, they're also looking at, well, what is the implication in terms of clean energy and all of this? That can greatly improve things. And I was at a roundtable last week, and I was actually quite impressed with the intake of new MPs that have come through. A lot of them actually do have some background in understanding planning. So if they can unlock that, because everyone knows how it can take years, if you like, to get some of this stuff off the ground, if they can just shorten that planning process. And look, I mean, there's no chance of getting to, a clean power 2030 plan without planning being significantly changed from where it is now. So those are kind of 2 or 3 main areas which come through on the report.
When you talk about de-risking, and that's something that I talked about with Greg McClymont too, about this sharing of the risk between the government and the investor, and that the government has to kind of basically live with the fact that it's going to give up some of the return really to encourage private investors into this field. Is when you talk about risk, you've talked about contracts for difference, talking about not changing the goalposts, to making sure that investors can predict what kind of income streams they get. You've mentioned planning as well. So is there risk at the beginning of the project that maybe governments need to think about too? Is it about making sure that a project can get off the ground. And even maybe if it's talking about developing a greenfield site, that they take some of that upfront risk as well. Can you talk to me a bit more about that?
Look, I think it's fundamental. The reality is pension funds as a whole, like things like core infrastructure, they like to see great transparency in what they're investing in. They will take risk in infrastructure, but they're not crazy about greenfield type opportunities. And they're also not, I think, generally keen on, well, they're keen on new technologies. So things like sustainable aviation fuels, hydrogen, green steel. These are all conceptually very, very interesting, but it's unlikely that pension funds would be the kind of the first capital to go into those spaces. So it is the multiplier effect is essentially, which we talk about in infrastructure investing. If there is a, if you like, the kind of venture capital that goes into really thinking through the concept stage, as I said, all the way through to development stage, and then passes that, if you like, on to the pension fund who just prefer a more longer dated, transparent model, if you like, where you're seeing cash flows that make an awful lot of sense, then that's the multiplier effect. So maybe 10% of capital can go into that early stage, and 90% comes in from those bigger institutional investors after that. But it is risky. But the problem is that it just won't get enough off the ground as quickly as what's needed, given the fact we have those 2030 targets to address without that first risk capital, if you like.
And so do you think that the government is on the right track at the moment to get pension schemes to invest more in the UK, or is there more they could be doing? And obviously we're recording this podcast against the big investment conference that's going on today. Yeah,
I mean, so look, I actually think it's good that the government has shown a level of impatience. They want to get things done to the point of just even mentioning planning. I mean, that's you better deal with it now, because there's 3 or 4 years down the road, it's too late into the administration for that to work. So there is this real appetite. I think what's great about this particular report, it's basically saying these are the things you have to do. You do them, you'll get the results that you want. So I'm not saying there's no place to hide, but it's been spelt out in no uncertain terms. Pension funds, and I think we have to be realistic in the UK, the corporate defined benefit world is on the road to buyout. So it's not going to provide any significant infrastructure capital. The LGPS is different. It's, as you know, it's a huge scheme, about £400 billion of assets. It's also well funded. It's an obvious investor in infrastructure. If you actually look at certainly our partner funds have been investing in private markets, certainly with us over the last 5 or 6 years, the largest asset allocation that they've made in private markets has been to infrastructure. So I think the LGPS is certainly doing its area, doing its best to get more into infrastructure. Obviously, it needs to tilt that, as I mentioned, from global to UK. Others, defined contribution, maybe we'll see a more appetite in the next 5-10 years around private markets, and that within that, maybe a third of that might be into infrastructure as well. But it's really to the point that you mentioned about the international conference that's happening now. If we can get, on a par in terms of the environment, the investment environment with other major countries, and we provide the kind of infrastructure opportunities that come through. It's the international pension funds in the US and Canada and Australia and elsewhere. And, they have a history, if you like, some of them investing in the UK, but that can be dialed up even more as well. So I think the government seems to be aware of where the capital is and what they need to do to kind of get it moving.
Yeah, I mean, I think that the theme that comes out again and again is that what we need to do is not kind of browbeat pension schemes into investing in the UK. It's about making the whole of the UK investable. If you make the UK investable, you almost don't have to do anything. You can sit back and relax because the money will flow in. And the money will flow in not just from the UK pension schemes, but also from other international investors and other big institutional investors, as you mentioned, in Canada and Australia. So it's a kind of a switch of mindset, I think, about making sure that you make the UK investable. And if I can be a bit cheeky, and I'm not putting words into your mouth here, Joe, then maybe the government needs to consider every aspect of that, including our relationship with the EU and thinking about growth. That's what I said, not what Joe said. So I do think that there needs to be a level of honesty. And hopefully with this report, we begin to get a bit closer to a level of honesty. That's my little soundbite for the podcast. So we've talked, you're saying that they're very clearly laid out what the government needs to do to encourage investors to make the UK more investable. Let's talk now about what role a pension pool like the one that you're in charge of investment of can play in all of this. What can you do to build this infrastructure that we need to meet our net zero targets?
Well, let me start by saying that the report does actually highlight some case studies from UK as well as international pension funds who invest in the UK, and there's some really good stories already around that. For example, Nest have invested heavily in offshore wind just off the coast of Yorkshire. USS own Moto, which is as you know, is a large motorway service element, but also kind of a real focus on growing electrical services centres for vehicles in their forecourts as well. And Central, another LGPS fund, has done a lot in developing solar capabilities. So actually, LGPS funds and pension funds more generally in the UK who have that longer term growth focus, not the ones that are focused on de-risking. They have already done a reasonable amount in this space. Border-to-Coast, we have our own climate solutions. We're on our second fund. We've raised a lot of capital through our partner funds for that. We also have a UK opportunities fund, and we've invested in things like compressors, which regulate the stability, if you like, of electricity onto the grid. We've invested in offshore wind, also EV charging as well. So more of this. We want to do more of this. But again, it's a very simple equation. It's when you go to a pension fund committee, and we're going to talk about capital market assumptions next year, they will say, look, I want to feel more confidence that the expected return is going to be up and the risk is going to be lower. So I feel that, because obviously, as I said at the beginning, some have had bad experiences, but if they feel as if there's a momentum there from a regulatory perspective, from a financial backing perspective, then they will have more inclination, if you like, to adjust that balance towards UK from global infrastructure. The same actually could be said in private markets as well. But private equity and getting growth into this country is hugely important. We have a huge venture capital industry in this country, but it's not really backed by pension funds. But if they feel as if things can change from a regulatory perspective, and if they feel as if there's more backing, if you like, for listing companies in the UK as well, you'll get that shifting back in terms of how advisors view the opportunity set in the UK, and therefore you'll get a decent allocation, I think, to domestic investors.
And how much, when you're thinking about investment, do you play into? Sorry, I'm going to do that again. When you're thinking about investing, how much does your consideration of your local responsibilities, and I know that you're quite a big pool that covers, as is in the name, border to coast. How do you think about building infrastructure for local communities versus this kind of bigger economic problem of infrastructure for the whole of the UK?
Well, as I said, it's interesting the planning side of things. If you're going to oblige, looking at energy infrastructure into local planning, that will mean thinking about what makes sense for the composition, if you like, of energy for each part of the UK. I think that's hugely positive. I mean, for us, we obviously work with our partner funds. We want to see more regional investment. That's hugely important for us. It's very important for them as well. But at the end of the day, I think infrastructure has to be kind of a national program as well, and that's why a lot of the success hopefully will come from the successful execution of the GB Energy and then the National Wealth Fund and so on. They will be the catalyst, if you like, for growth in some of these areas. In a very simple sense, I mean, we have wind up north and we have solar down south, so it is diversified in terms of the reality of implementation. But the speed of implementation will probably come down to regional prioritization of this message of 2030 transition.
And when you say regional prioritization, do you mean, is that something that local governments control, or is that something the central government controls?
I think it's a combination. I think the tone can be set centrally. I think those vehicles that I mentioned are kind of national, but they're also going to have a regional breakup of priorities as well. But yeah, planning has to be looked at locally as well. So it all has to be tied together. And time is of the essence. I mean, we didn't set the objective of 2030. The government did. And as I said, the sheer amount of gigawatts that has to come online to hit the objective of 100% clean energy by 2030 is only 6 years away. So it's not possible for the national government to do without cooperation of local authorities.
Okay. And if we were to talk again, say in 2 or even 5 years' time, and you felt that those 15 to 20 recommendations had been followed, what would good look like?
What would good look like? Okay, more confidence. So we see better, higher allocations amongst pension funds to domestic UK infrastructure. In reality, we need to see more projects come online. So early stage de-risking examples. And we have to be clear here. This is risk taking as well. And it's not going to be a smooth path. Not everything you invest in, particularly in terms of kind of, new technologies, is going to work out as well as people would like. But the effort has to be made there. As I mentioned, things like hydrogen and, green steel and so on. All of these, there's risk associated with them. But we have to recognize why we're doing this. It's basically to bring it to the point where pension funds can make that higher allocation. So moving projects through to early stage, from early stage de-risking, and then you see, greater construction and work by pension funds and other investors to really take it to the next level. Transformation of the planning process. I don't see how any of this works without that happening. We have to get away from planning announcements. It was said last week, you can make an announcement, but where's the actual work being done to actually make it happen? I think, we have to see evidence of that. But if you look at the time frame, it has to happen within the next 12 to 24 months for any chance of getting anywhere near those objectives. So good looks like all of those things. But this, it'll be really positive for this country if we can make this happen. Like I said right at the beginning, we have a lot to be, proud of, and the fact that 40% of our electricity does come from renewable today. So that's positive. We are definitely, we're not behind everyone else. It should be clear in that we're just, that extra effort that's needed is significant. But we should also recognize that there will be those who'll push back and say, look, I don't believe that we'll have consistency for a policy of the next 15, 20, 25 years. And I think it's really important that there's cross-party support for all of these initiatives. Yes,
absolutely. We need some long-termism. And just to go back to the headline of the article, which is about Rachel Reeves being encouraged to change her definition of fiscal rules. Is that part of what good would look like? Would we have a more holistic definition of fiscal rules to encourage more investment?
Well, yeah. Look, I mean, the ask isn't different from other countries. So actually, there's a quite a good, and I suggest everyone should get their hands on as I said, this blueprint. There is a good case study there in relation to the Canadian Infrastructure Bank, which provides the capital, if you like, for de-risking, and that operates under fiscal rules, which are the ones that we're suggesting that the UK should move towards as well. So we're not asking for something that's different. Sorry, IFM are not asking for something that doesn't exist elsewhere. And as I said, I mean, I feel, rationally speaking, there's a big difference between, fiscal expansion in order to be able to do short-term benefits or whatever, which may or may not be appropriate, to those that are structural. And structural infrastructure. Infrastructure is the most structural change you can make, and they are assets. So borrowing money in order to be able to put it into infrastructure, I think, shouldn't just be viewed as a debt. It's also an asset. So to me, it's illogical that is the case. And I think particularly when you have fiscal constraints, which we do, maybe thinking about that qualified redefinition makes sense.
Yeah, I mean, it's a strange one in a way. There were plenty of articles in the FT before the election with basically the city sort of saying, please change the fiscal rules. We're absolutely here to invest in infrastructure. It's been the reverse of what you would expect. It's not the government having to sort of run around to persuade people that they're not going to be profligate. It was almost the reverse scenario.
Yes, because as I said, it's a completely different animal. It's investing for the future. It's tangible. It's could create greater efficiencies in the country and good returns for investors. Pensions in the long run. And look, the LGPS is an open scheme. It is inflation uncapped, and duration wise, 80, 90 years plus. It needs long-term assets and infrastructure. It ticks a lot of the boxes. So, if you can get those more investment in that space, there's the initial investment, initial risk taking, you'll get those benefits. So, yeah, I mean, from my view, I think, as you say, the city is very supportive of taking a practical approach on this, and it could, huge dividends can come from that.
Well, I think that's a great place for us to end our discussion. Thank you, Joe, for sharing your news story of the week and all those fascinating insights. And everybody needs to rush out and get the blueprint and read it. That's your key takeaway, isn't it?
Yes, absolutely. Thanks so much, Charlotte. I'd just like to say thank you to IFM. It's great to see an asset manager go the extra level, if you like, and not just focus on what the opportunities are for them, but recognizing that the industry itself has to change.
Listeners, if you enjoyed this episode, make sure you never miss a future episode by hitting the subscribe button. Thank you, as always, for listening, and thanks again to Joe.
Thank you, Charlotte.